strong conviction here. We've got the investment pros, Matt, Jim, and Scotty with us. Dominic Tavella. So then it's not just the rug being pulled out from under them, Jim. It's just the incompetence down there. And I do believe it's having a direct impact on our economy.
You know, we all ask our kids, or in my case, nieces and nephews, to get along and reach across the aisle. They're not doing it down in D.C. I do want to say, though, household net worth spiked more, has increased more than over a year. So get ready when the good weather comes. I do believe there's some pent-up demand, and I think you're going to see some.
Well, that's what Jonathan's saying, although it does feel like it's somewhat bifurcated. You know,
Matt went outdoors, I went indoors. I went with electronic arts. They have a massive sports title. Their year-over-year growth in that area is over 80%. I do think they're a best rapid growth. They're managing their expenses. I like them a lot. And I think more people are going to sit in front of their computers or their video games and keep on plugging along.
Well, if they don't.
We thought they were going to go through the roof, but they're real companies with real earnings, real sales, real profits. So at the end of the day,
I agree with you, Dominic. But I think what is also different today versus 2000 is a lot of value, which Charles was talking about, is being extracted pre-IPO. There is a much more mature market for private shares trading, for investments coming in. There's rounds and rounds of investment. So again, by the time it goes public, I do think there's some concern that these things have now been inflated. They're rich. So I'm not saying these are absolutely real companies. They are rich they're often rich.
What's happened since 2000, Sarbanes-Oxley and Dodd-Frank, which has made it harder for companies to come public.
Correct.
So I agree.
But to Dominic's point, all the made-up valuation metrics, eyeballs, clicks. Today, Box, the CEO, I think this guy's making a terrible mistake. He's at war with the analysts because they don't know how to analyze his company. The last person I heard say that was a couple years ago was Groupon. They made up their own valuation metrics, and they think Wall Street's not buying it. Investors aren't buying it.
Yeah, he was on his network earlier as an interview, and I wasn't buying it either. I mean,
all right, Jim?
You either teed me up or crushed me, because I'm going with Groupon. Fall 2011, the biggest internet IPO since Google in 2004. It's a different business today. They got blasted for the deals. They now sell more than half their revenues come from goods. They sell goods. By the way, about half the revenues from Amazon comes from goods. So people don't care where they're buying it from. If they get it cheap online, they are a goods man. They sell goods. Guess what? Groupon's going to be back.
The earnings have been beating the street recently. Irish Friend was asking, what are your feelings on Coke long term? It's a tough one because I got a feeling it will be up long term. This is a Warren Buffett favorite, but it's got a very narrow trading range. They're one-dimensional. They are taking market share, but they're taking market share in a market that's shrinking. I like Pepsi better. I love Monster if you want to be a little bit more risky. Coca-Cola, guys?
I mean, look, despite the strong dollar and the headwind, despite the move away from unhealthy drinks, they still raise their dividend. As you said, it's a blue chip. It's going to be around, and I say it's good for a portfolio long term.
I'd buy here in